inflation artificially coming down. I don't believe in any of that. I think it's temporary.
Ladies and gentlemen, I just met Egon von Greyerz in Munich at our Forum One event, and now we are back in the virtual world. Egon, glad to see you again here on Zoom.
Yes, well, it was good to see you also in Munich. It was obviously a new format that you laid on, and an excellent format, I think, and a lot of interesting people and investors there. So I congratulate you that you pulled that off, that major change, and it certainly went well from the Edelmetallmesse to, is it Forum One, isn't it? Forum One.
Correct.
Yeah.
Yes.
Okay.
Sure, we built on that, Egon. Now let's have a look at the markets. It seems everything is back to normal. What was the reason? Let's have a look at the chart first. Something happened last Tuesday, the 14th of November. The Dow Jones jumped up. Now we are back to 35,000. What was the reason? CPI numbers. Let me quote here. The consumer price index was flat in October from the previous month, but increased 3.2% from a year ago. Both were below Wall Street estimates, sparking a major rally on Wall Street. Seems the investors are back to normal, Egon, and they celebrate and they buy like crazy. Back to normal, really?
Well, we have this perma bull attitude now among investors that both good news and bad news make the market go up, and here we have inflation artificially coming down. I don't believe in any of that. I think it's temporary, and if you read and study actually how they can define inflation and what subjective tools they have to adjust it, basically just because they think it's too high, they can adjust it lower. So any person who lives in a normal economy is not looking at 3% inflation today. So that's not real, and I think this is a correction to an uptrend in inflation and an uptrend in interest rates, and therefore we should not pay too much attention to this temporary euphoria. I don't think stock markets are going to go up further. They might come up a little bit from here, but the trend is down, and at some point it's down in a major way, whether that's happening this year or at the beginning of next year. But stock market investors are always buying the dips and always happy that the market goes up and finds always a reason to buy the market.
I also would not bet on an increasing market, Egon. Nevertheless, insanity can last longer than we think. What did Zero Hedge write? The higher for longer soft landing economy may be transitioning back to a Goldilocks economy of not to have hot, not to have cold activity and inflation, that this week at least created a particularly attractive backdrop for stocks, but realistically, everything just traded together like the QE trade, stocks up, bonds prices up, gold up, dollar down. I think for a while, we really could expect the interest rates to be flat and coming down, but probably a temporary development, as you said. And this is also supported by some deflationary pressure. Is the luxury goods bubble bursting? We read here an article that Burberry sales are falling and even the prices for luxury watches are declining. And from the US, we have a similar development. People run out of money, or at least run out of money to buy useless goods or not necessary goods, and the retail sales are declining. Retail sales in the US decreased by 0.1% month over month in October 23, putting an end to a 6-month streak of increases and compared with a market consensus of a 0.3% decline. Sales at miscellaneous store retailers recorded the largest decrease, followed by furniture stores. So there is definitely downward pressure, deflationary pressure, which would support the Fed to stop increasing rates. But nevertheless, there are other forces that paint a picture of increasing rates again. And sooner or later, not just because of the pressure to the economy, the mounting debt, the refinancing, we discussed everything, there will be a QE necessary. So I think this is only a phase of deflationary pressure that opportunistic people can use, but I would not bet on this to persist for much longer. What do you think, Egon?
Well, yeah, if we start with the luxury goods side that you mentioned, that has been one of the biggest bubbles in the world, in my view. No, just take that the one of the richest person in the world is Arnault, which is the principal owner of the biggest luxury goods group in the world, LVMH, Louis Vuitton, Moet Chandon, etc. What has happened is that, as we know, the rich has been getting much richer because of these bubble markets in property, stocks, bonds, even and private equity, etc. And the wealthy don't know what to do with their money, so that they spend it on things that they don't need. So that's why you find 1,000 euro or 100,000 euro handbags, for example, and people have to wait a year to actually order one, even, so that because they make them scarce, these products. That's that bubble will of course burst when asset markets burst, which is something that we'll probably see during 2024 and coming years. And then again, the fact that retail spending is down. I mean, that's obvious. People don't have any money. Retail spending will continue down. But in my view, we will still have inflation. So you will have low spending and high inflation. We've seen it before. I've seen it in the 70s, and we're going to see it again. Remember, the 70s, I experienced the whole of the 70s when the interest rates were going up continuously, and the economy was extremely weak, and the gold price went up dramatically together with interest rates. Remember that interest rates and gold can go up together, and do very often. So that's not an opposite relationship with them at all.
And not just the retail customer is under pressure, also the companies, they have to refinance loans, and now obviously at much higher rates. Unfortunately behind the paywall, but still I could read something. Some of the largest US companies face billions of dollars in additional interest costs and hits to their profit if they refinance their 2024 maturities at current rates, with a third of them lacking the cash to repay upcoming debt. Non-financial companies in the S&P 500 have a combined 107.7 billion in debt coming due next year, with an average interest rate of 2.8% according to CalcBench analysis seen by First Bloomberg News. Refinancing at 5.44%, the rate of the one-year Treasury bill in early November, would add another 3.09 billion in collective interest expense. This speaks for this deflationary pressure that we'll have for a while, but on the other hand, it will increase the losses of the companies, the refinancings, and they will call louder and louder to the Fed to start QE again, right? And then the bottle is opened and the printing presses will run, and then we see what we expect.
Yes, I mean, these higher interest rates, people haven't really reacted to them yet, but that's will start in earnest during next year. As you say, there is refinancing taking place on first of all on mortgage loans around the world. People have had maybe a couple 2-year fixed loans or 3-year fixed loans, and a lot of that is maturing next year. And of course, especially in Europe here, people have gone from 1% interest rates to now 3, 4, 5% interest rates on their mortgages. People are not going to cope with that. There'll be massive defaults on that side. And the same goes for commercial property. Again, they have dual problem of not just higher rates, but also lower vacancy rates, because people are not working in offices anymore. A lot of people are working from home, if they work from home, because most of the time when you try to find people these days, you can't even get hold of them. Then you have also companies, as you say, have to refinance debt. And then let's not forget the government. The US government has, I think it's about 8 trillion out of their 33 trillion maturing next year. And that's at low rates again. That's at 2% or so, and now they're looking at maybe 5% refinancing, and that's just going to make the interest costs of US debt going up into the sky, and they can't afford that either. Well, they can, of course, because they just print more money, but that will again create the inflationary cycle that we know is going to come back because of the massive money printing in all of these areas that you just outlined, because government is going to have to print to help the banks, to refinance the banks, and as well as help themselves. And the governments don't have any money except for fiat money. And just imagine what this printing and these deficits, what effect that will have on the economy and on inflation and of course on the gold price, because it's the currencies that suffer. So the currencies will go down, and gold will reflect that, of course. So we will see gold going up considerably in the coming year. But what people shouldn't worry about really is currencies going down or gold going up. What they should worry about that holding your money in the banks now. These banks that are going to, the crisis we saw in the spring, that's going to continue and accelerate and get a lot worse. I could easily see governments saying that half of the deposits in the bank, for example, goes into forced saving into treasury bonds for fixed or frozen for 5 years or even 10 years. That could easily come, especially in the US. So therefore, if I were a US citizen, I wouldn't keep my money in the bank. And as we know, Jan, gold is a much better alternative, better protection, better wealth preservation, and it's if you hold it outside the banking system, it's out of reach of the government also.
The banking system, Egon, that was a good keyword, and I completely agree. If you have money in the USA, be careful, rather put it into gold. I only want to read one headline from Zero Hedge. Big banks see 63 billion deposit outflows last week. Loan volumes continue to contract. So the banking crisis, as we also discussed in the past, is not over. Who knows how long this phase of deflationary pressure will last, but to print money has been always the easy and convenient way. I think, Egon, when the inflation starts again, it will be very rapid. Why? Because we still have the effects from Corona. A lot of supply, factories, etc., supply chains were destroyed. We have sanctions, ideological madness that increase the prices everywhere, or that have driven the prices up already. Many companies go bankrupt, so the supply will also shrink. And then less supply, prices will increase also for that reason. What do you think?
Yes, absolutely. As I wrote in my last article, the cycle of evil. We have these cycles of on the one hand, of the geopolitical risks of 2 major wars, and we shouldn't believe that any of them will go away. They will last for a long time, and of course and it's both wars are involving the US on one side, backing one country, whether it's Ukraine or whether it's Israel. And on the other side, you have Russia, of course, in Ukraine. And then you have in Israel, you're not talking about just Palestine. You have the whole Arab world. So you're talking about a couple of billion people if you take the whole Arab world. So and that is a conflict that will not stop, and it could get a lot worse. So we have those risks which we have to watch out for. And then we have, as you have outlined here now, we have talked about all the financial risks. So, the absolutely reason for wealth preservation is greater than ever because of the risks. You don't buy gold because you want it to go up. It's better that it doesn't go up, because if it goes up, it reflects massive problems in the world. You buy it because it's the best insurance you can have, as long as you have it in physical form outside the system. And really, that's what people should think about now. Don't wait for these risks to materialize in a lot more serious events. We could see wars, we could see the banking system collapse, etc. And government defaults. That's going to happen in the next few years. And prepare for it now. Don't wait. That's what we have to tell our listeners and viewers, Jan.
And it seems that even central banks are looking at massive problems. I found a very interesting article on zero hedge again, Egon. And I nowhere in the mainstream press read anything about that. It seems that the Netherlands are preparing or taking precautions to maybe initiate a new gold currency. I quote, in a recent interview, the Dutch central bank shares it has equalized its gold reserves relative to GDP to other countries in the Eurozone and outside of Europe. This has been a political decision. If there is a financial crisis, the gold price will skyrocket, and official gold reserves can be used to underpin a new gold standard according to DNB, that is the Dutch central bank. These statements confirm what I have been writing for the past years about central banks having prepared for a new international gold standard. And now, what we know already, Egon, the beauty of gold is that it's stable in value, it retains its value. That's one of the reasons why central banks hold gold. Gold has intrinsic value unlike a dollar or any other currency, let alone Bitcoin. Gold has value on its own. It's a fungible product. It's a liquid product. You can buy and sell it almost anywhere in the world. So it's really an outstanding commodity to base an exchange rate system, in brackets, gold standard on. Isn't that a confirmation what we, of course, know already? But now to hear this from the Netherlands is quite remarkable.
It is, because governments know that they don't really want to reveal how they are mismanaging the economy by constantly debasing the currencies. And of course, that's what gold reflects. Gold doesn't go up. Gold just holds a stable value, but all the currencies are going down rapidly. But now they're confirming that gold it protects against that. But they of course should also say don't hold the money that we issue, because it's going to becoming worthless by the day. But I mean, this what you read about the Dutch central bank, etc., and a gold standard. I'm not a believer in the gold standard. I don't think it'll be a good thing, because that will be subject to manipulation also. I believe much more in free gold. And of course, the whole world is not going to agree on a gold standard, because the BRICS countries and the East, they will do what they want. China and Russia, etc., the big holders of gold, are not going to agree with the West, what they do. And they're the ones increasing the gold reserves, not the West. The West are not buying gold. It's the East that's buying the gold, and the South. So, I think it's more likely, as we have discussed before, that the gold price will go up, because central banks will no longer hold dollars as their reserves. They've done that, and in various central banks, they've held U.S. Treasury bonds as the currency reserve. But now, with U.S. confiscating Russia's funds, for example, no government will want to hold an instrument that can be confiscating. So I think the whole system will go over from dollar-based to gold-based reserves. And in my view, that is what's going to make a major change to the gold price. And I don't think it's going to happen overnight. It'll just be a gradual shift, and making constant demand for more gold by these various governments. And as we know, there isn't more gold in the world. You can't make more gold. So the only way for them to have more gold is by the price going up. And that's what we're going to see. And that's not going to be by small percentages. That will be by big percentages, but it's not going to be something, as I said, happening overnight. It's going to be over a certain period of time. That, to me, is the best way for gold to have a continued uptrend for the simple reason that governments around the world and people will realize that that's the only asset to hold to protect against the various risks that we discuss, you and I, Jan.
Let's conclude, Egon. We are not back to normal, of course not. And we have the geopolitical risks that can change everything overnight. So I really would not bet on a continued increasing stock market, as many propose now. Take precautions, use the time that remains. Just as we talk, gold is approaching $2,000 again. A final statement, that's the place to be, Egon.
Yes, and that's for the simple reason that is the best way to protect your assets and protect your family. And, we'll have very difficult times ahead. So, that is key now. Look after your family and finances, because they go together. And because, as I said, we will have some very hard times ahead. And at least if you have that side covered, then you are in a good position.
To our audience, a remark. Next time in December, we will do a Q&A session again. So please send us the questions to Egon von Greyerz via email or put it into the comments below the video, and we will then answer them in the December issue. Thank you for today, Egon. Have a good time in the UK, and we talk in a few weeks again. Thank you. Bye-bye.
Thank you, Jan. Always good to talk to you. Thanks.
Thanks. Bye-bye.